Vanguard's 2026 market outlook projects U.S. large-cap returns of 3 to 5% for the next decade. After their own 3% inflation forecast, your real purchasing power from an S&P 500 portfolio grows by essentially nothing. And here is what nobody in the financial headlines is actually saying. The S&P 500, the one thing most Americans in their 50s and 60s are almost entirely concentrated in, is specifically the worst performing equity category in Vanguard's entire global asset class forecast. Not mediocre, worst. So when this video's title says the party is over, I mean that precisely. The specific decade you have been expecting. The one where your retirement account compounded at 12% a year like it did from 2015 to 2024. That decade is gone. Not paused, gone. And Vanguard, with roughly $10 trillion under management and a quantitative forecasting model they have spent decades refining, is telling you the next 10 years look almost nothing like the last 10. I have 3 Vanguard reports to walk you through today: their market outlook, their U.S. economic outlook, and their dedicated retirement research. And I want to show you 3 specific traps this new environment is setting for boomers and Gen X. Because the problem isn't a crash. The problem is something quieter, slower, and in some ways harder to defend against. A decade where you barely move forward. And a retirement plan built on assumptions that belong to a different era. By the way, I built a free early retirement calculator because most of the ones online are mathematically wrong. They use 7 or 8% return assumptions that look nothing like what Vanguard and BlackRock are actually projecting right now. Mine uses current institutional forecasts to find the weak spots in your plan, and I only ask for your email to send you the report. I don't store any of your financial data. Link is in the description. Here's the metaphor I'm going to use through this entire video. Imagine a restaurant, best place in town. For 10 full consecutive years, this restaurant served a menu that was almost embarrassingly good. Every dish hit. You didn't have to be clever about what you ordered. You didn't need to know the chef or pick the right seat. You showed up, sat down, and left satisfied every single time. That is what the S&P 500 gave investors from 2015 to 2024. Roughly 12 to 13% annually compounded, without needing to be particularly smart. Showing up and buying the index fund was the whole strategy, and the strategy was correct. Now Vanguard walks in and takes a seat at the bar, and they say, quietly, in a very long document most people will never read, the chef is tired. The prices are stretched. The same dishes will be on the menu for the next 10 years, but they are going to taste a lot different. The restaurant is still open. I want to be clear about that. Nobody is telling you the place is closing. But walking in expecting the same experience you had for the last decade and sitting down to something dramatically more muted, that changes your strategy. Especially if you are in or near retirement and your monthly expenses depend on what this kitchen is able to serve. Here are the 3 traps this new environment is setting. Trap 1. The S&P 500 is not giving you what you think it's giving you, and hasn't been for years. Trap 2. Even Vanguard's already low return projections don't fully capture how specifically destructive this environment is for retirees, because of a mechanism most people understand only vaguely. Trap 3. And this one has nothing to do with asset allocation. What gradual retirement actually costs you in years you cannot recover. And throughout this video, I want you to keep someone in mind. His name is Marcus. 56 years old, Gen X, has done everything the financial internet told him to do for 20 years. Maxed his 401k every year, bought index funds, stayed in through every correction. He is sitting at $900,000 today. His plan has always been to hit $1 million and retire at 62. Last week, he got a push notification summarizing the Vanguard report. Read the first paragraph, closed the tab, made coffee, moved on. By the end of this video, Marcus has a specific plan. Whether he executes it is his business. In a few minutes, I'm going to show you something about sequence of returns risk that will permanently change how you see the 3 to 5% number. But first, Let's talk about what you actually own when you own the S&P 500. You think diversification is the product, but actually, concentration has been the product all along. And it worked so well for so long that almost nobody noticed. The top 10 companies in the S&P 500, Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and a few others, currently make up approximately 35 to 38% of the entire index weight. 35 to 38%. If you put $100 into a standard S&P 500 index fund, roughly 36 of those dollars go to 10 companies. You do not own 500 businesses in any meaningfully balanced sense. You own a technology-heavy concentration play, with 490 other companies as supporting cast. Now, that concentration is exactly why the last decade was so good. Those 10 companies absolutely dominated global equity returns. The S&P 500 outperformed almost everything else for 15 years, primarily because it was, in practice, a leveraged bet on the largest U.S. technology names, dressed up in the language of broad market exposure. And that bet paid off spectacularly. But Vanguard specifically classifies those names as U.S. growth. Their projection for U.S. growth? 1.9 to 3.9% annualized over the next decade. For U.S. large cap overall, 3.1 to 5.1, and with inflation projected at 3%, subtract that from the low end of the U.S. large cap range. What do you get? A real return that rounds down to approximately nothing. This is not a crash scenario. This is a slow diminishment. A decade where your biggest positions technically go up, but not enough to outpace the cost of living. You don't feel it in year 1, you feel it in year 5, when your portfolio is nominally higher than it was, but your purchasing power hasn't moved. When the math feels like it isn't working the way the plan said it would. When the restaurant is still open, but every meal is a little smaller than you remembered. Back in the late 90s, the Nasdaq looked exactly like this situation, just faster. The logic was airtight at the time. These companies are real. The internet is real. The growth trajectory is real. All true. And then, from 1999 through 2002, the Nasdaq fell approximately 78% from peak to trough. Not because the thesis was wrong, because the price paid for the thesis had completely disconnected from any reasonable expectation of future return. Sound familiar? Vanguard is making a structurally similar observation today, not a crash call, a valuation call. The specific word they use, notably out of character for their usually measured institutional language, is stretched. U.S. equity valuations are stretched. That is, the firm managing $10 trillion telling you in the politest possible terms that you might be paying a premium price for a future that delivers below-average returns. The defense most people reach for is predictable. The S&P always recovers. It does. It also took approximately 14 years to fully recover from the 2000 crash in real, inflation-adjusted terms. The point here isn't crash risk. The point is return compression risk for people in or within 5 years of retirement who cannot wait 14 years for a recovery that should not have been necessary in the first place. The restaurant is still open, but if you need the kitchen to deliver during a specific window, the timing matters in ways it never did when you were 35. Vanguard's U.S. economic outlook adds some important context. They're projecting GDP growth of about 1.5% this year, unemployment near 4.7%, core inflation holding at approximately 3%, effective tariff rates running near 17% by year-end. That combination, slow growth, a softening labor market, inflation that won't fully subside, is not the economic cocktail that historically produces double-digit equity returns. It's the environment that produces exactly what Vanguard's models are forecasting. The kitchen conditions explain the menu. And here's what Vanguard is quietly pointing toward instead. International developed markets, Europe, Japan, Australia, projected at 5.7 to 7.7% annualized. U.S. value stocks at 5.8 to 7.8. Global equities overall at 5.1 to 7.1. nearly double the US large cap projection across the board. The back table at the restaurant is serving materially better food right now. Almost nobody is sitting there. Every financial planning seminar I have ever attended had some version of a slide that said, "The market always comes back." True, the Japanese Nikkei index peaked in 1989. It didn't recover to that level until 2024. 35 years. The slide was technically accurate. It was not a retirement plan. Now here is where it gets genuinely uncomfortable for retirees specifically. In a minute, I'm going to show you what Vanguard's retirement-specific research found, something that has almost nothing to do with returns or allocations. But first, let me show you what happens when a 4% nominal return meets a retiree who needs income every single month. You think the problem is low returns, but actually, the problem is what low returns do inside a retirement portfolio that is actively being drawn down. This is sequence of returns risk. Most people understand it loosely. Fewer understand the specific mechanics well enough to defend against them. Here's the math. 4% nominal annual return minus 3% annual inflation equals 1% real return. 1%. Your balance is technically going up. In purchasing power, the actual goods and services you can buy with that money, you are running in place. Now add a 4% annual withdrawal rate, one of the most conservative benchmarks in retirement planning. You are withdrawing 4% of the portfolio per year to live on, growing at 1% in real terms. Your portfolio is declining in real purchasing power every single year, quietly, without drama. Like a slow leak in a tire you didn't notice until you checked the pressure. Let me tell you about Raymond. Raymond retired in January of 2000 with $600,000. Did everything right. Diversified reasonably. Planned to withdraw $24,000 per year, 4% of the starting balance. Conservative by any measure. Then, 2000, the S&P 500 returns negative 9%. 2001, negative 12%. 2002, negative 22%. 3 consecutive down years, right at the very start of retirement. Raymond's portfolio wasn't declining only because of the crash. It was declining because every withdrawal, every $24,000 he pulled out to pay his mortgage, buy groceries, cover healthcare costs, came out at the worst possible time, when the portfolio was already contracting. He was selling depressed assets to fund current expenses, not by choice, by necessity. The sequence, the specific order in which returns arrived, destroyed a plan that would have worked beautifully under almost any other timing. Same savings rate, same discipline over a lifetime, same annual withdrawal. Different sequence, completely different outcome. Now translate that risk into Vanguard's current forecast. The threat isn't a dramatic crash in year 1. The threat is 6 or 7 years of 2 to 3% nominal returns, a normal 15 to 20% correction somewhere in year 4 or 5, and then a slow, multi-year recovery. No crisis, no headlines, no dramatic market event to point at. The restaurant keeps serving food. The food is mediocre, and you keep paying the bill every month. Because retirement costs real money regardless of what the kitchen happens to be doing. By the way, if you're finding this useful, hit subscribe. YouTube has a specific and genuinely irritating tendency to stop surfacing my content the moment you don't click that button. Takes 2 seconds, and I do this kind of deep dive into institutional research every single week. Here's where Marcus comes back into the picture. 56. $900,000. Everything in the S&P 500. Target, 62. He got the Vanguard summary notification last week, read one paragraph, and closed the tab. He's not in crisis. He's running on a model built for a restaurant that served 12% annual returns. The kitchen changed, and he closed the tab before anyone told him. I will come back to Marcus with a specific plan, but first, the home bias problem. Because this is where the Vanguard report goes from warning to roadmap. Stay with me, because in a few minutes, I'm going to show you why the timing and structure of your actual retirement, specifically whether you do it gradually or completely, interacts with the current return environment in a way that most people have not thought through at all. But first, why almost every American investor is concentrated in precisely the wrong bucket, and exactly what that costs them. International developed markets, 5.7 to 7.7% projected annualized returns. U.S. value, 5.8 to 7.8. Global equities overall, 5.1 to 7.1. And yet, the average American investor holds between 80 and 90% of their equity portfolio in U.S. stocks. The academic term for this is home bias. Every serious behavioral finance researcher has documented it thoroughly. Dozens of peer-reviewed studies confirm it is irrational, and virtually no retail investor corrects for it in any meaningful way. Here is why. And this is the psychology of money piece that genuinely fascinates me. Humans invest in what feels familiar. Familiarity registers in the brain as safety. Safety gets rationalized as smart. And so you tell yourself that concentrating in American companies is economically sound strategy, when what you are actually doing is paying a comfort premium, buying the feeling of understanding an investment. And that feeling is not a compensated risk factor in Vanguard's capital markets model. It does not earn you extra return. It costs you projected return in the current environment. There's a well-documented cognitive pattern. Kahneman's work on heuristics touches on it. Shiller's research on narrative economics expands it, where people consistently overrate the quality and competence of institutions they are culturally or geographically close to. Not from careful analysis, from proximity. If I can drive past the headquarters, the investment feels sound. If the company is based in Stockholm, something about it feels speculative. Even when the data says exactly the opposite. The S&P 500 has outperformed international developed markets for roughly 15 years. That is real history. And that history is precisely why American investors feel justified concentrating in U.S. stocks right now. But here's the trap. This is the cleanest, you think X is the problem, but actually Y is the problem, I can offer you today. The 15 years of outperformance is itself the problem. Prolonged outperformance of one region inflates valuations. Inflated valuations compress future return expectations. Compressed future return expectations are exactly what Vanguard is now projecting for U.S. equities. The very history that makes U.S. concentration feel rational is the mechanism making relative U.S. underperformance more probable over the coming decade. Vanguard knows this. Global diversification is the cornerstone of their 2026 strategy recommendation. Their words, not mine. The restaurant is still open, but their model is pointing at the back table. The back table has historically grounded return prospects. Almost nobody is sitting there, not because the food is bad, because the other table was better for 15 years, and the habit of sitting there got very comfortable. A simple rebalance toward international developed markets, getting from 90% US exposure to somewhere around 65% over 12 to 18 months, is not a dramatic restructuring. It is a meaningful adjustment. And it is exactly what Vanguard's own research recommends. A Vanguard FTSE Developed Markets Fund, or a broad total international stock market fund, does the job without requiring any exotic strategy or market timing conviction. Now, the most important section. And this one is not about returns, not about which funds you hold. This one is about time, specifically the kind you cannot buy back. Here's what nobody in the financial media is framing correctly, from Vanguard's retirement-specific report. It has nothing to do with asset allocation. Vanguard surveyed 1,500 people on retirement expectations and behavior. Here's what they found. Among people who are already retired, only 38% actually retired gradually, reduced hours, shifted roles, eased the transition over time. But 62% of people who haven't retired yet plan to retire gradually. A 24 percentage point gap between what people intend and what actually happens. Most people who plan for a gradual exit don't fully achieve one. And here's what Vanguard doesn't say directly, but the behavioral research does. Many of those who do manage to retire gradually end up wishing they hadn't. Here's the truth about gradual retirement that doesn't appear in financial planning brochures. It is a trap, wearing the disguise of prudence. The behavioral research on retirement well-being, conducted across multiple research institutions over multiple decades, consistently shows that people who retire fully, who make a clean and complete exit, go through a difficult adjustment period of roughly 6 to 12 months, and then their well-being scores rise significantly and durably. People who retire gradually often never complete the psychological transition. One foot stays in the door. The adjustment never fully arrives, and the cost is not philosophical or abstract. It is measured in years of your finite life. Between 60 and 75, most people experience what researchers call their go-go years, the window where energy, physical capacity, and cognitive sharpness are all simultaneously present. That window is finite, completely and irreversibly finite. If your go-go window is 15 years, which is generous for most people, and you spend 5 of them doing work you could have stopped, you have consumed 33% of your healthiest retirement capacity on a salary. That figure does not appear anywhere on your 401k statement, but it is just as real as any balance. I worked with an accountant for years when I was running my business. Sharp guy, understood money at a level most people in his profession don't reach. He used to say, "The most expensive thing you can buy is a year of your own life. Most people spend it on a salary." He retired at 63, his wife at 61. They are in Portugal right now, not because they are spectacularly wealthy, because they ran the math differently than most people do. Here is where the Vanguard market data and the retirement behavior research intersect in a way that I think is genuinely underappreciated. In a world of 3 to 5% projected nominal returns and 3% inflation, the spreadsheet argument for one more year of work becomes more seductive, not less. The numbers say, one more year of income, one more year without drawing down the portfolio. That is a meaningful 2-year positive swing on paper. And it is true, on a spreadsheet. But one more year is also 1 year of your go-go window. And unlike your portfolio, the go-go window does not compound. It does not recover from a bad year. It does not respond to tax optimization or smart asset rebalancing. It diminishes at 1 year per year, in one direction only. Vanguard's lower return environment makes the financial case for staying in look more attractive. That is precisely when you should be most suspicious of that argument. The party might continue. The returns might beat Vanguard's projections. They have been wrong before, but Vanguard's invitation says the party ends at midnight, and they are telling you it is 11:45. Whether you stay is your call. The decision should be a conscious one, not a default. The gradual retirement plan is always, "I'll consult part-time." Nobody consults part-time. The part-time consulting becomes a full-time arrangement without the benefits, which is a job, with worse health insurance and no paid vacation, and the psychological weight of never having fully let go. Let me give you a scenario with actual numbers, because vague financial content is comfortable and useless. A couple, both 58 years old, combined portfolio of $750,000. 90% in a standard target date fund, effectively S&P 500 heavy, which is where most pre-retirees are sitting today. They plan to retire at 63. Social Security kicks in at 67. Combined projected benefit of $3,200 per month. They need about $6,000 per month to live comfortably in retirement. Before Social Security, they need to pull approximately $2,800 per month from the portfolio. After Social Security starts, roughly $1,000 to $2,000 per month. Under the old assumptions, 7 to 7.5% annual returns, their $750,000 grows to approximately $1,077,000 by age 63. At a 4% safe withdrawal rate, that generates about $43,000 per year, roughly $3,500 per month. Covers the pre-Social Security gap with room to spare. There's margin. There's buffer for a medical event, a home repair, a bad market year in early retirement. Under Vanguard's 4% nominal return projection, that same portfolio reaches approximately $913,000 at 63. 4% of $913,000 is about $36,500 per year, about $3,040 per month. They cover the basics, but the margin is gone. The buffer is gone. The $164,000 difference between those two scenarios is not a number. It is the difference between a retirement that can absorb normal life surprises and one that cracks under routine pressure. Now they make one specific move, calibrated to the current environment. They are in the 22% federal tax bracket. Starting at 58, they convert $45,000 per year from their traditional IRA to a Roth account. That costs approximately $9,900 in additional federal income taxes per year. Call it $10,000, rounding up. Painful in year one. Over 5 years, the total tax cost is $50,000 paid out of pocket. At 63, that Roth balance, 5 years of $45,000 annual conversions growing at 4% per year, is approximately $244,000, growing tax-free from that point forward, forever. Their traditional account is now smaller, which means their required minimum distributions, starting at 73, are significantly reduced. Lower taxable income in retirement. Potentially lower Medicare Part B premiums, which are income tested and can run $200 to $500 per month for higher earners at elevated income levels. Less of their Social Security benefit getting taxed at 85%. More actual money deposited into their checking account monthly, not on a tax return. Modeled conservatively over 25 years of retirement, the tax efficiency gains from this one move alone, not a sophisticated investment strategy, not market timing. A Roth conversion executed over 5 years saves them between $75,000 and $150,000, plus the Roth balance growth itself, plus the optionality of a tax-free bucket available in years when traditional account withdrawals would otherwise push them into a higher bracket unexpectedly. The restaurant didn't get better. They ordered smarter from the same menu. Now back to Marcus, 56, $900,000, 100% S&P 500. Target retirement, 62. If Marcus does nothing, holds the same allocation, runs no Roth conversions, retires at 62 on autopilot, his $900,000 grows to approximately $1,139,000 over 6 years at 4% annual growth. After adjusting for 3% annual inflation over that same period, the real purchasing power of that $1,139,000 in today's terms is approximately $954,000. He ran on a financial treadmill for 6 years. He technically moved forward. He did not gain real ground in purchasing power. He basically stood still while working. Now Marcus makes 3 adjustments. He rebalances to include 30% international developed markets exposure, moving off 100% U.S. stock concentration towards something closer to what Vanguard's own projected return data supports. He starts $45,000 per year in Roth conversions, running through his retirement date, and he retires cleanly at 62, instead of letting the low-return environment make the financial case for waiting until 65 feel rational. He does not arrive at 62 with dramatically more money than in the do-nothing scenario. What he has is structured fundamentally differently. More of it grows tax-free going forward. More of it sits in asset classes with higher projected returns, and he has 3 additional go-go years to use for whatever he intended retirement to actually be, not 3 more years of running the same treadmill while watching the spreadsheet and hoping the numbers eventually improve on their own. Marcus's plan was never broken. It was running on assumptions from a decade that ended. The fix is not dramatic. It's boring and specific, which, if you have been watching this channel for any amount of time, you know is the whole point. 3 specific things you can do this week, calibrated exactly to what Vanguard just published. First, audit your international exposure today. Open your brokerage account right now. Find your equity allocation. Look at the U.S. to international split. If that number is above 70% US, you have home bias, and it is actively compressing your projected returns relative to what the actual institutional forecast data says is available in the current market environment. Consider a gradual rebalance over 12 to 18 months, not all at once, so you're not making one large market timing bet toward international developed markets. A Vanguard FTSE Developed Markets ETF or a total international stock market fund handles the execution without requiring any complexity. Getting from 90% US exposure to 65% US is not a dramatic restructuring. It is a meaningful and Vanguard-supported adjustment. Second, if you are between 55 and 65 with significant balances in traditional 401k or IRA accounts, model a Roth conversion strategy before year-end. Find out what tax bracket you occupy right now, then calculate what your required minimum distributions at 73 or 75 will force your annual taxable income to be. If the RMD period bracket is higher than your current bracket, and for many people with substantial traditional balances, it will be, you are choosing, by inaction, to pay higher taxes later when you have zero control over the decision, rather than lower taxes now when you still have full control. The current tax rate environment has a political shelf life. This specific move requires the least sophistication and delivers some of the most reliable return available in any environment, regardless of what the market does. Third, if you are within 5 years of retirement, rerun your plan using Vanguard's actual projections. 4 to 5% nominal returns, 3% inflation, instead of whatever default assumptions are baked into your planning software. Most retirement planning tools still model 7 or 8% annual returns. Those numbers belong to the decade that just ended. See what the real current projections do to your outcome scenarios, not to frighten yourself into paralysis. To give yourself accurate information while you still have time and meaningful options to respond. A retirement plan modeled on returns that already happened is not a plan. It is nostalgia with a spreadsheet attached to it. Lazy investing built more fortune than crypto memes. But lazy planning, keeping the assumptions that worked before because revising them is uncomfortable. That's how you end up at the restaurant, ordering the same thing you always ordered, noticing quietly that something tastes different, and saying nothing because you don't want to deal with what it means. The restaurant is still open. Check the new menu before you order.